Welcome to Galaxy Brains, the weekly podcast from Galaxy Research. As always, I'm your host, Alex Thorne, head of firm-wide research at Galaxy Digital. We have a wild show today. It's been a crazy week. First, we're going to talk markets with Beimnet Abebe, as always. Then I'm going to give some thoughts and some background on this FTX Alameda situation. Really a bad situation. But we don't know everything, but I'll share what we do know and what we can say. And then we're going to get our friend Tyler Williams, the head of public policy at Galaxy, to weigh in on the impact of FTX and in Washington on crypto policy, and also the midterm elections. It's going to be a wild one, and I'm happy you're here for it. Before we begin, though, please refer to the disclaimers in the link on the podcast notes, and note that none of the information provided during this podcast constitutes investment advice or a recommendation, solicitation, or offer by Galaxy Digital or its affiliates to buy or sell any securities. Got that disclaimer out of the way. Let's get to it. Welcome to our friend Beimnet Abebe from Galaxy Digital Trading. Great to see you, man. It's been a wild week, obviously. The FTX stuff has moved crypto markets dramatically. But also, we just had a CPI print, and I guess inflation's still increasing, but at a slower pace than expected.
Correct.
Which is what? That's bullish?
It is good. So, what happened today was you got inflation numbers that came in lower than expected. So headline CPI came in at 7.7 versus expectations of 7.9. So you had a pretty significant miss to the downside. That miss was largely driven by softness in things like used auto prices, health insurance, slightly lower rate of positive inflation on like rents and owner equivalent rent and housing. And a couple other sort of idiosyncratic factors. But it's the first time in a really long time where inflation surprised to the downside. And so the market, has had a very violent reaction afterwards. And the most immediate reaction was in the rate market, where you basically started to price out more than one full hike. So front-end rates moved lower by about 35 basis points today. And so you basically, with the most important part being that December is now looking like a 50. And that caused, equities to rip higher as well.
They were big. I mean, I saw at one
NASDAQ's up 6% as of this podcast right now. That's a function of a couple of different things. One, positioning, right? Folks are really short, or underweight equities.
Right.
Two, base effects. Right? Like when you've come down so much, right? Like small moves higher or tend to be higher percentage moves, right? That's just how the math works.
Of course.
And three, the companies are actually reacting to what they think was going to be a slowdown in macro conditions next year, right? You had Meta yesterday announced 11,000 job cuts. Today, you've had Amazon announce, a lot of like cost-cutting measures that are coming. So the market has a sense that these companies are going to be fiscally responsible. They're not just going to let their revenues and profits decline without at least trying to tackle it from the expense side of the equation. And so, the combination of positioning, good fundamental news, that means the Fed has to be less hawkish, and you've had some pretty dovish Fed speak this morning as well. The highlight of that Fed speak is mainly in the context of, they think that monetary policy is less laggy from a transmission mechanism perspective than originally thought. The idea being is, mortgage rates going to 7%. They might take 6 months, not 8 months, to fully filter into the economy. So there's a bit of that going on. But high level, I think you're exactly where Powell told you you were going to be, which is he told you at the SEP FOMC that they expected rates to go to 4.5%. The last FOMC, he told you that given the data, we now expect rates to go beyond what we forecast in SEP FOMC. So where are you now? You're implying 485, which is 475 to 5% band, which is exactly sort of where, I think Powell told you he was, at FOMC, right? But the risks in my head are still skewed to the upside, right? So right now you're just having a positioning, driven like rally and sell off and other things. But fundamentally, this market is a market that's going to be driven by inflation.
Yeah.
Right. So we have to think about the factors that drive inflation. And one of the biggest factors is the labor market. And the labor market is still so strong. I mean, people have jobs. I get it. You're seeing these like layoff announcements here and there. But at the end of the day, the unemployment has barely nudged any higher.
Yeah, on a net basis, the big number, the open job number went up, right? I mean,
there's still way more there's over 10 million job openings in the market.
And that deficit between the large amount of jobs that are open and the small number of people that are looking because they're already hired pushes wages up, right?
Absolutely.
And that's a huge source. People feel wealthier when their paychecks are bigger, rightly so.
Absolutely.
And then they're willing to accept higher prices at the pump, at the store, at the at the bar, wherever, right?
And wherever it may be.
Yeah, and which is one of these awful realities we've talked about, right? The dual mandate from the Fed. Like, they're in direct conflict with each other right now.
And there's a third one, apparently, which is not to rock the boat on Election Day. But we can get into that later.
Yeah.
In my head, though, it's really like when this kind of like price action happens, it's like so counterproductive. It's like whenever like rates rally like crazy and stocks go higher, that's going to help drive inflation higher.
Yeah.
Right? It's like, okay, when NASDAQ's up 6%, if people are like not as panicked about stocks just like puking lower, like they're going to spend more money. There's
that's
a positive
that wealth effect.
Wealth effect.
Yeah.
Exactly. To like, huge holdings of like U.S. consumers like going up.
It's
right.
Just...
When the dollar sells off again, because now U.S. interest rates and interest rate parity, like they're going lower, right? That means our imports cost more, right? That means when oil, in theory, is going to be higher on a dollar-denominated basis.
Right.
Right? And so it's so counterproductive right now, and markets tend to get way ahead of themselves, right? So I think, what Powell spoke about last meeting is really what you sort of have to pay attention to is what is the real risk for the Fed right now? Is it over-tightening, right? Or is it under-tightening? And what are you like more comfortable living with,
and you think,
and I still think you should go into the over tightening camp, right? Because the set of tools available that the Fed has to react to an economic downturn are insane. Think about it this way, right? When we were cutting rates during COVID, you cut rates from like 2% and change, right? So you only had 2% and change to go down in,
right?
And you bought, $3 trillion of assets and, $120 billion per month of securities like thereafter, right? And so now you have, you're going to have 500 basis points that you can cut, right? A much higher sort of wealth base, and like consumers are like have a lot more savings and feel a lot more wealthier,
right?
And so you're in a really strong place, and so you have the ability to over tighten without worrying too much about it because you can cut so much. You can go back to doing QE. Like, we know what happens when the Fed turns dovish, and that is all asset prices rip. And the other thing to keep in mind is I genuinely don't know if we will get another asset bubble like the one we just got. It is literally the exact same as what you saw in 2000. You had, meme coins, pet.coms, right?
Yeah.
Ripping to insane
literal
valuations.
Unprofitable meme stocks, like
homes selling within hours of listing.
Yeah, I heard
right.
Yeah, I mean, selling in cash,
property,
selling in cash, like 200K over ask. I mean, insane stuff, right?
Insane, ludicrous levels of stuff. And so if you want to get back closer to an equilibrium, you're really going to have to like tighten conditions in a material way.
Yeah, your point here is they'd be better off over tightening than under tightening.
Absolutely.
Because if they screw up, if there's a hard landing, which, I mean, if you over tighten, not just tighten, but let's say you tighten too much, then the implication is that the economy goes into a bad recession. Then they have tools for that, to your point.
They have tools.
Whereas if they let inflation run away, it's very, very dangerous. And
it's so dangerous. Yeah.
So,
but the other thing that I did leave out is the very obvious risk, and one that everyone should be focused on, particularly in the context of like what just happened in crypto, is financial stability, right? Like there's pockets of leverage business models that just don't work once you get to super high levels of interest rates. And so there's a genuine concern for financial stability as you keep tightening financial conditions. And you saw that with the Bank of England, right, when their bond market literally blew up.
Yeah.
Right. This is England. It's not like Paraguay or like
sometimes. No offense meant to Paraguay, but a tiny small country, for example.
Love my Paraguayans.
Correct. Yeah. No, you're right. Absolutely a huge issue. Real quick before we end. Just broad thoughts on the crypto markets that now, I mean, obviously their CPI was beneficial, like the rise in risk that we saw today on Thursday was beneficial for Bitcoin and Ethereum and other assets. But that's not the primary thing that's been moving crypto prices this week. I mean, what have you seen with the fallout in the market from FTX?
I think the key things are trust. That's really the only thing that matters in markets. I come from a trading world where I say done on a trade, that's it. You don't need
it's done.
It's done, right? Yeah. And it's good as gold.
Your word
right?
is bond.
But now it's like, who do you trust?
Yeah.
Right? If you can't trust the guy that was advertising on the Super Bowl that had Brady and Giselle and Steph Curry.
FTX Arena testifying before Congress.
I mean, the Forbes cover.
Right.
Who can you trust?
Right.
Right. And so, I definitely think that there's a huge lack of trust. And it's not just the CeFi institutions, but it's DeFi as well, right? You've had an insane amount of smart contracts exploits this year, right? And so when you throw that, like, if you think about it, you've lost a lot of trust in CeFi institutions, right? Because a big one just went away. DeFi, you're not comfortable with the smart contract risk. So you're just left with like a very like trustless, investor base.
Yeah.
But I think my key takeaway from that is that the future needs to be as decentralized as possible, right? Like, I don't want to take counterparty risk anymore in my head, at least right now. I might change my mind in 10 minutes,
I get it.
But like, it's like, I just want to know for sure that it's all rule based.
I mean, the way I think about it,
the margining is all rule based, and I'm guaranteed to get my stuff out, and it's in a blockchain that is likely not going to get exploited unless I do something stupid.
Yeah, I mean, the way I think about this is that there's going to be centralized service providers, there's going to be CeFi in every market
to be compliant,
but they should be regulated and transparent. I mean, this is where. And if you're not that, then you need to be fully decentralized, right? It's been really surreal watching this happen while we're here at Galaxy. One of the only two publicly traded with publicly audited financial trading firms in crypto, right? I mean, we are significantly more transparent by nature of being a publicly traded company than, a buy side, market maker like Alameda or even basically any exchange on earth, I think, other than Coinbase, right? So between, I think you got to be one or the other. I mean, you have to be transparent and regulated, or you've got to be fully decentralized. I don't think there's a middle ground.
I think you're 100% spot on.
Beimnet Abebe, Galaxy Digital Trading, thank you for joining us as always, my friend.
Happy to be here.
All right, let's talk about the big news this week. FTX, Alameda appears to be a huge blow up. It's been widely reported now on today is Thursday that in multiple outlets, the Journal and Reuters have reported that client funds specifically were lent by FTX to Alameda, meaning funds belonging to depositors on the exchange, FTX International, FTX.com, were sent to Alameda for some purpose. This is something that I think the crypto community over the last couple of days has come to assume. There was a really, truly excellent analysis performed by a friend of ours and someone we respect a lot, Lucas Nuzzi, the head of labs at Coinmetrics. That thread was widely shared on Twitter. He found some on-chain data that suggested significant flows from FTX to Alameda over the summer and at the end of the spring, and the implication being that Alameda had some kind of blow up at the end, during the events of the spring that with all the CeFi lenders and all that stuff, and was, I guess, replenished in some way by FTX clients, unbeknownst to them. I will disclose, which has been disclosed already, Galaxy was a user of FTX in order to perform our trading business for our counterparties. And clients. We have funds on many exchanges, right? And we manage that actively. We disclosed during our public earnings call on Wednesday that we had about 77 million of exposure on the FTX exchange, right? So literally funds on the exchange that are currently not being processed for withdrawal, right? So, and there's many others in this industry. Some have been public, some have said they have exposure. Some very few have detailed it, and I will say, I think we're probably the most specific that has detailed it, and that's by virtue of us being a public company and having those responsibilities. I don't want to fully speculate too much what actually happened here, but there's a lot of key takeaways I think to talk about. It's first of all, it's just very obvious that if there's a liquidity crisis at an exchange that's not supposed to have any leverage itself, that means there's money missing, right? So that's why people knew. I mean, when withdrawals halted in particular, it becomes very clear. This is a thing where you put your money on the exchange or your coins and you want to swap them between things, right? And in the case of FTX, you could also do futures and other derivatives. The money's supposed to be sitting there though. Right? It's not, when you see a balance in this exchange, it's supposed to be there. It's not supposed to be lent to some other party. It's not supposed to be, being used for speculation by an affiliated market making firm. It's not supposed to be used for yield farming. It's not supposed to be doing anything. It's not even supposed to be sitting in treasuries. I think one time during this saga, Sam Bankman-Fried, when he was still claiming that all the money was there, he said, we don't invest client funds, not even in treasuries, he said. Well, treasuries would be bullshit also. That money's supposed to sit there as I deemed it as a customer. And, you can tell I'm very angry about this because of all types of blowups in finance. This is the one major, the worst thing you can do if what we think happened. Misappropriating client funds is the worst financial crime that can be done as far as I'm concerned. And that's what it appears happened. There was also, from a pure story standpoint, if we step back here and I'll talk about what I think the impact is on crypto markets generally, and the medium and long-term prospects for this industry in a minute. But when you step back and think about the saga that this has been, I'll just recount some of the timeline. So on Wednesday of last week, CoinDesk published a story apparently having viewed a leaked copy of Alameda's balance sheet. And it's interesting. We all sort of looked at it, people that watch this industry were looking at it with peculiarity. It was kind of weird. It looked like they had no Bitcoin. They did. I don't think they had any ETH. They had a ton of Solana. A lot of it was locked. They had a ton of FTT, FTX's own coin, and that's really where this sort of all the fears really emanated out of this FTT position. So after about 24 hours, I think the market was digesting this. Everybody started to say, "Wait a sec, this balance sheet is super illiquid." Right? They had something like what CoinDesk had published said something like 14-ish billion in assets against 7 point something billion in liabilities, which were loans, right? They owed money. But the problem was the collateral listed on there was super illiquid, right? FTT's their own token. It was widely it was very centrally owned. Like I forget the numbers here, and we looked this up a few days ago, but it's already past me. But a huge percentage of the FTT supply was owned by a very small number of entities, and it's primarily FTX, Alameda, and then probably some huge users of FTX.com that and it was Binance. Binance owned a lot of it, I guess, by virtue of having been an early FTX investor, CZ, which they exited that position, that venture position, I guess as part of the exit or something, they received something like $2 billion in FTT, which they've been holding. So on Thursday, people started to really start talking about this balance sheet. And then on Friday, something like 23 million units of FTT worth over $500 million at the time was seen moving onto the exchange, onto Binance, I think, at the time. Everyone's like, this is a huge, especially for that coin, that's a huge amount of units to be, right? The assumption in on-chain analysis when it comes to trading is that if something moves onto the exchange, it's likely to be sold because you don't move it there and do nothing, right? And, if coins come off of an exchange, you assume that they were purchased, right? It's pretty simple. It's not always true, but it's a heuristic. So this was all over Twitter. The Whale Alerts Twitter account had published this, which they do on an automated basis. And people started to speculate that this could be Binance. Like, this looks like Binance. There was actually a fair amount of speculation that it was Binance. And then CZ on Saturday confirmed, the CEO and founder of Binance, that it was Binance. And the tweets were pretty cryptic. He basically said, it's not like because of anything in particular, but we manage our positions actively. And so we'll be dumping $2 billion of FTT. And he said he would do that over a course of time such to not move the market. But of course, this caused, it's not clear whether he did do it over a nice period of time, but it started to cause panic about FTX in general, right? FTT is this exchange token, which is in and of itself a sort of a peculiar and nebulous type of crypto asset doesn't really exist in traditional worlds, these exchange tokens. But a lot of people, like rightly or wrongly, look at exchange tokens as some sort of proxy for the health of the exchange itself. And FTT started trading down. On Sunday, SBF and CZ started basically going at each other a little bit on Twitter. And I think there was an accusation made by CZ that it's not a good look. I forget the exact language, but it's not a good look when you're talking with regulators and lobbying behind our back Binance against us. And I think there was another tweet from Sam actually several weeks ago, Sam Bankman-Fried, where they were saying, gosh, it's great if Binance is going to get involved in Washington lobbying. He can come to DC, right? Is what Sam tweeted. He's since deleted that tweet. The implication being like, I don't know, would CZ be arrested if he came to Washington? I mean, and so there's clearly was like some no love lost between these two guys, at least specifically around Sam's Washington lobbying efforts. That's what CZ said on Twitter on Sunday. There were several on Monday. FTX started to experience problems with withdrawals. Alameda was found on chain to have been removing assets from DeFi protocols, as in like withdrawing, gathering all their capital together. They had, I think, a compound position they wound down, something in Gearbox, which is like a generalized derivatives platform, I guess, or maybe lending. And so it looked like they were circling the wagons, right? So again, now at this point, it's starting to be a little bit of a fever pitch. So on Tuesday, FTX halted withdrawals in the morning, and then no one knew what was going to happen. This is like maybe it was like 6 a.m. It was seen to halt 6 or 8 a.m. on Tuesday. By 11, however, both CZ and SBF tweet that there's a deal that they've signed. They've each signed a non-binding LOI for FTX.com to be acquired by Binance pending due diligence. Now, FTX.com is the big FTX. It's the international FTX. It's not FTX US, which is, as far as we know, a fully separate entity. And again, I say that because we don't really know. I don't actually know. I think people are, given the ties between Alameda and FTX, you have to start wondering, sure, it's not crazy to wonder if FTX US is involved in this. But I will say that FTX US, as far as we're aware, never has halted withdrawals. So it would make sense for it to be different, because that's the whole reason they made it, so that they could have a regulated U.S. version of their exchange. But anyway, that was explicitly not included in this supposed deal. They both said specifically FTX.com. And then we all waited to find out what would happen. And ultimately, the next day, what is it now? Wednesday? So Wednesday, CZ backs out of the deal. And he basically says it's too bad for us. It's too big. The hole is too big, whatever it is. It's something, I forget the exact language, but we can't fix it, right? It's beyond our capability to fix. At this point, we start to get real reports, right? I mean, now we start to see the media first of all, the media was all over this on Tuesday and Wednesday. Anyway, there's not really much more news after that, except that we've gotten reports now that the hole could be $8 billion, I think Wall Street Journal says. which is just insane because I'm pretty sure FTX had about 16 billion total in client assets. That would mean that they had lent half of their exchange's assets to, well, if it's Alameda, then it's to themselves. It's to Sam's prop firm. But to be clear, they shouldn't be lending it to anyone. That's the real core point, right? This is custody. It's not custody if you give my assets away, it's just unbelievable behavior if that's true. But we're in a spot now where we have the most prominent crypto advocate in Washington, a seeming wonderkind who built an empire out of nothing in 2.5, 3 years, who pledged to give $10 billion of his money away to charity over the next 10 years, who had spent lavishly on political campaigns and advocacy, who believes supposedly in effective altruism, says that he wants to get rich so he can help the world, is extremely public, is on Twitter on a regular basis. You have this guy completely blow up his entire business. And in this case, and unlike some others that have happened this year, but also like some others, at the expense of his clients. And that type of misappropriation cannot go unpunished in any market. And I don't know how this is going to resolve, but I will say that the crypto markets are going to be punished by this. And of course they have been on the liquid crypto Bitcoin trade was at almost at 21K, traded all the way down to in the 15s. I think today, as we record this, it's trading in the 17.6 range, which is sort of like June lows when the Three Arrows Capital situation happened. But we went below that already, which is pretty unsettling. But all the FTX linked projects and tokens, the Solanas, which is linked because Sam Bankman-Fried had been a huge proponent of Solana. I mean, it's not actually linked as far as I know in any way, which is hopefully that. Which should be good for the Solana community, that there isn't actually, except that Sam owned a lot of it and promoted it a lot. Solana, Serum, these other assets which is an exchange on Solana, all down crazy bad. I mean, I don't even know where Solana is now, but on Wednesday, when I last looked yesterday, Solana was trading down like 66% from its high over the weekend. Which is when the Solana Foundation had their Breakpoint conference in Lisbon, which is, I'm told, a great conference. One of our guys, Saul Kadir, was there, said it was awesome, but a big fall. So markets are hurting because of this real breach of trust at what was seen as a core market infrastructure. And I will just add, too, I mean, I don't know exactly, but a minor silver lining, I guess, for Americans, and I don't think it will go a long way when it comes to regulators and policymakers, is that this is mostly an offshore international exchange, not a U.S.-based regulated one. And so I think, depending, I'm not going to name any other names because I don't want to cause any issue, but if it were some other one, mom and pop would probably be hurting a lot more. I mean, it looks to me like this is a lot of professional traders and trading firms that primarily used FTX. So I don't know if that is a silver lining. I mean, we're one of them, so we're pretty upset about it. But, it doesn't seem like this was people DCAing in their weekly paychecks at FTX for the most part. But I don't know if that's totally right, but maybe that's something. But for the crypto narrative, this is a huge, huge blow. Probably mostly because not the real narrative, certainly Bitcoin and ETH unaffected, right? Like they're trading lower, but for the institutional adoption of crypto assets as an asset class, this is a major setback because this is key market infrastructure. This is a guy who testified before Congress calling for regulations, saying that what happened in 2008 and 2009 in traditional financial markets can't happen on FTX. He literally said that, right? Well, honestly, this looks a lot worse than a lot of the stuff we saw happen in 08, 09. This type of apparently intentional misappropriation of client money. And that it will be a setback for the crypto narrative in Washington. And it will be a setback, I think, for institutional investors. A lot of institutional investors, big allocators and pensions have invested into crypto through venture capital because the peculiarities of crypto assets make it harder for them to go directly into the asset. And this was a blue chip VC investment, FTX. I mean, I'm not going to list all the the folks who invested, but major pensions and some of the world's biggest investors. And I will say one, because they reported it themselves, Sequoia was one, and they said they're marking it to zero, right? And I haven't seen any of the FTX stuff, but like that seems prudent based on what we know, right? Or what we think and what we know. So that's a huge zero. It was last valued at $32 billion, I think, in their previous publicly disclosed financing. So that's a $32 billion to zero for those investors, which is rough. Again, these are the investors in FTX.com, the business, not the traders and users who deposit exchange stuff onto the exchange. As we've already said, we're one of those, and we people like us have withdrawals frozen. I don't know. We don't know if it's there. We know we can't get it right now. So anyway, I mean, I just want to, I've been in crypto and in Bitcoin for a long time, and there's been a lot of stuff like this. You got Mt. Gox, an exchange that also kind of did the same thing. Most people think they lost the funds, didn't steal them, but because that's technically better than stealing them. There's Mt. Gox. There was other exchanges have been hacked. There was the Bitfinex hack, and they found those. Razzle Khan, that's her name. I forget her real name, but that's her rap name. She lived like in an apartment in Wall Street. Was found to have had like the $3 billion of Bitcoin that had been stolen from Bitfinex just this year, which is just a hilarious turn of events in terms of who that was. But there have been a lot of things like this. But this one, given the prominence of FTX in Washington, I think in particular is the reason that it hurts so much, and just how public he was. So look, I mean, that's all. We're going to bring on Tyler Williams from our public policy team to talk more about Washington. Also, we'll talk about the election. I do want to tell everyone there's been bad stuff. This is bad, but like crypto is going to survive. Bitcoin and Ethereum and anything that's truly decentralized is going to survive. It's just that the narrative of the growth of this industry, like we have to come out of this somehow. You simply cannot let an exchange do this to people. It just can't happen, right? So something is going to have to give, and that's what I said with Beimnet a few minutes ago. We want a lot of stuff fully decentralized. We definitely do. Like we take Bitcoin, right? It doesn't work if it's not fully decentralized. It's essential. But if there's going to be service providers that are companies that operate in this space, like this is an exchange. It's literally like the heart of finance. Imagine if the New York Stock Exchange stole all of your Apple stock and lent it to someone. It's unbelievable, right? It can't happen. So, look, I'm proud at Galaxy that we are, I think, as far as I can tell, at least one of the two most transparent companies by virtue of our structure. And that's just going to be the way this has to go. Like this can't happen again. But it's going to be hard to bring the institutions back without something like that. This was seen to be one of the most trusted venues, and it apparently was not. So, hey, but again, Bitcoin and ETH, they're here to stay. You know me, I'm a Bitcoin guy, but I've come around on Ethereum as well. So those things are fine, functioned as normal. So, if you're stacking sats, TikTok, next block, the blockchains are working, but we need some help here we need transparency. Quick break for our listeners. The results from last week's poll, we asked, who do you think will win the ZK EVM race? More than half, 51% said Polygon ZK EVM. ZK Sync came in second. Scroll came in third. This week, though, we're asking a different question related to FTX. And the question is, what portion of funds do you think FTX depositors will eventually get back from the exchange? All of it? More than 50%? Less than 50%? Or none of it? Hit us up on Twitter at GLXY Research and make your voice heard. That poll is pinned to our profile. Now back to the show. Let's go now to our friend Tyler Williams, head of public policy at Galaxy Digital. Tyler, it's been a crazy week in Washington. How are you doing down there, first of all? And great to have you back.
Thanks for having me back. I'm doing well down here. It's sunny. We're anticipating some rain from the hurricane coming in. So I think the mood is going to become even more dour than it is in Washington right now.
When it rains, it pours. Tyler, so the FTX situation, which we've been talking about throughout this podcast, it has a unique impact in Washington and on crypto policy, given how active Sam Bankman-Fried was in supporting legislation and working with policymakers, how public he was. What are you hearing down there? Has everyone been talking about it? Just what's been the reaction from your friends and people that you work with closely in Washington?
Yeah, absolutely. I mean, it's totally consumed the airspace, and it's obviously consumed the airspace for me because I work in the digital asset policymaking arena. But I think even, withstanding the elections, it's been pretty much the constant theme of attention across all of my friends in Washington and across policymakers, just because of how much the digital asset policymaking community has grown in Washington over the past year, and then the sort of traction that the industry has received over the past 6 months in terms of advancing legislation and building momentum behind ideas. So I think it's really consumed the airspace in addition to the election this week.
And are people angry? Are they bewildered? Like, how would you describe the reaction?
I think it's a little bit of both, and it's both in the sense that when you're a policymaker or when you're a staffer on the Hill or a regulator, and you're working to understand an issue, a lot of times the issues and solutions to problems come up from direct advocacy from companies. Sometimes you hear them from their constituents. And, if you're someone on Capitol Hill, like usually what you try to do is look to identify an issue, create a solution to that problem, and then you want to tie it back to your local state or congressional district that so you can have a positive message for solving a problem for your constituents. So now you have a problem on both ends of the spectrum here. You have constituents that feel burned. You have policymakers and staffers who feel burned from a perspective of working on an issue, trying to solve a problem, spending all of the dedicated time to get something done on a bipartisan basis, and you sort of have the rug pulled out from underneath you. And oftentimes these ideas and solutions to problems that can come about pretty quickly, and it takes a lot of work to build towards a consensus. And you'd seen that in both chambers, really, in the authorizing committees from the Financial Services Committee and from the Senate Ag Committee, where we've seen a lot of staff work that's happened and principles from senator level and from a member of Congress level being heavily invested in advancing and creating progressive solutions to problems in the digital asset space. And they feel as if this is another setback.
He was so active and then so much had so much become the face of crypto policy in Washington. It's clear that people are burned. And I just want to play this video of SBF at a congressional hearing. And we'll use that to set this up. There's a lot of videos out there of Sam Bankman-Fried that, especially knowing what we know now, are extremely cringe. But I'm going to play this one and of Sam Bankman-Fried testifying in Congress.
Last thing that I'll say is if you look at what precipitated some of the 2008 financial crisis, you saw a number of bilateral, bespoke, non-reported transactions happening between financial counterparties, which then got repackaged and releveraged again and again and again, such that no one knew how much risk was in that system until it all fell apart. If you compare that to what happens on FTX or other major cryptocurrency venues today, there's complete transparency about the full open interest. There's complete transparency about the positions that are held. There's a robust, consistent risk framework applied, and we're excited to work with the CFTC on our U.S. licensed and regulated venue.
So, look, we don't know everything at all yet about this situation, but we do know that there was not complete transparency. We do know, it appears, at FTX, and we do know that there was not a robust risk framework if the size of the hole in FTX's balance sheet is as reported. So, Tyler, I mean, if you're a staffer or a member or a senator themselves, And you work with a wonderkind, and he's a leader in the space of a new space, and your constituents are interested in the space, and you're interested in the space, and you want to advance it, and you get a lot of support from this person on policy, and they're saying things like that, but then it turns out that they are perhaps the source of the problem, or one of them. I mean, how upset are you?
I think you're immeasurably upset by this and almost feel as if you were sort of duped, so to speak. It reminds me of some of the historical crises that we've had. If you remember, prior to the '08 crisis, it was very pervasive, the impact that Fannie and Freddie had in Washington policy. And then you fast forward a couple years later and they're in conservatorship owned by the government. I'm not saying this situation and the facts were going to repeat to be the same, but it makes you feel, if you're a policymaker, that the efforts that you were working on to enshrine the space, they are sort of all for naught. And I think you can end up having situations where this spurs legislative action and spurs regulatory action, but it can also set you back in terms of alienating the very supporters that you've worked so hard to build. And I think it's entirely the situation that in Washington, FTX and Sam Bankman-Fried were very prevalent in terms of Washington policy circles and testifying in front of House congressional committees about the efficacy of their legislative proposals and so forth. So I think it's immeasurably how much this impact could have in the short term, and then how much rehabilitation needs to take place to re-ingratiate and re-ingrain yourself in terms of being credible stewards on behalf of the industry.
Yeah, it's clearly going to be a big setback there in Washington. I think just broadly is what you're saying, like our friends in Congress, the crypto industry's friend, and I don't even mean that they're friends, but the people that are advocating for responsible regulation and policy, your fear is that they're going to be not receptive any longer to crypto?
It's not necessarily a fear of them being not receptive. In some ways, I think it can help push policymakers and regulators to a position of really putting some tight guardrails around the space. So for those companies and those trade associations have been advocating for responsible regulation, we could see that almost advance faster. It just makes people who are pushing that agenda more weary and less likely to just take the advice and counsel of people who are in the industry themselves.
I see. Yes.
So, and usually the old adage, and I think it was former chief of staff to President Obama said, never waste a crisis in a policymaking space. Like, we are in sort of a crisis era. So in some ways you could see it fast tracking legislation. It's just usually when that happens, the net impact of that law ends up being more punitive than it otherwise would have been.
Right. So let's talk about the election. Which was anyone watching the election on Tuesday? I remember I normally am a big political watcher and love election day. And I didn't check the results until about 4 a.m. the next morning. We were so fixated on the drama between, at the time, SBF and CZ from Binance. What happened in the election this week?
Yeah, it was funny you say that. I obviously I'm in DC. I've worked in politics, policy, and finance since 2011. And I went to a good friend's election party. It was just really like a small gathering at dinner, and everyone was talking about the FTX situation, despite it being filled with a group of lawyers, sort of policy people in Washington.
Not talking about the election that much.
Well, people were talking about the election, obviously, but this was a major theme. I think if you were like to tick off the 1, 2, 3 themes, it was in there in the top 3 of like what people were asking about. And I think the other interesting thing is like, I was the only person who was in the digital asset space there. Everyone else was a lawyer or
not related to crypto at all.
Yeah, not related to crypto at all, other than being in DC.
So what did happen on the election, though? It looks to me like it's mostly a wash, which is, I guess, a surprise to many in the media. But what's your take, and where are we?
Yeah, so, I mean, the balance of power is unknown right now, right? In the Senate, we still have a number of undecided races, so the balance of power is still in flux. In the House, there are a number of races that have yet to be called, but it looks like we're trending towards a Republican House, so a change in the control of the House chamber. I think the macro themes, and this isn't shocking to anyone, is that it's viewed as Republicans largely underperformed in the environment. And I think that if you were a Republican expecting to take control over both chambers as sort of a repudiation on the president, typically what we've seen in past midterm cycles is that the party that's not in power has fared better. That seems to be true for Republicans. It's just not as pronounced as people thought it would be. And I suppose I have a few key takeaways from it. And it seems like this midterm election cycle was largely about sort of abnormalities in both parties. On the Democratic side, it seemed like the trends from an inflation level and from a consumer confidence level and from sort of the macro environments, from crime to the historic levels of like drug overdoses, et cetera, that would be like the driving thematic trends that would oppose Democrats. And on the Republican side, you had some pretty staunch actions in the Supreme Court, and those top line themes there,
reproductive rights.
Exactly.
Yeah.
And then also, just the looming thing that stands out is that the predominant figure of the Republican Party lost the presidential election, still serves as like the key point person for the party. So it was largely about abnormalities. And to me, I can't remember the exact trend, but no president has won a re-election facing a major economic crisis since like the 30s, basically.
Yeah.
And historically in the midterms, we've seen like the off party win more. So it seems like this is a little bit of an anomaly of an election cycle, but anomalies are only relative to current history.
So do you think it's going to be tight, right? I mean, we don't know the Senate yet, but it looks like we could be headed for we could end up right where we are at a 50-50, but even if Republicans can flip it, it'll be like 51-49 probably, right? It's like barely. But if we assume that the House does go into the control of the Republicans, then we will flip all the committee chairs, right? The committees will become, right? So, for example, if Republicans win the House, then Maxine Waters will become the ranking member on the House Financial Services Committee, and Patrick McHenry will become the chair of the Financial Services Committee. And these are the two members that had been working on that stablecoin legislation in House Financial Services. Maybe with that as an example, or anything else that makes sense, how would that impact crypto policy in your mind, if at all?
Yeah, so that's probably like the most underscored thing here is that if and when the House does flip to Republican, the margins by which it's going to do are much less than what we thought. And what that means is if you're the Speaker of the House, presumably that's going to be Kevin McCarthy from California, when and if he comes in to be the Speaker, he's going to have to manage a very tight margin. So the House is all governed by, can you get to 218 votes in the House? And then there's a number of different protocols or ways that you can bring votes to the floor. What incoming presumptive Speaker McCarthy has said is that he wanted to give a lot of deference to the committee chairs to work their will and for that to really drive policy. Having worked for a speaker before, that works if you have a large majority, and then you can sort of have an incubation process that can lead to the development of policy to bring to the floor. That is going to be much more difficult if you're managing getting to 218 on a constant basis. And what I mean by that is if you're managing 218 members and their votes, it all comes down like everyone has birthdays, they have graduations, they have things to go to. And if you want people to show up for votes, you're going to have it be around pretty pronounced, prominent things. Or you're going to have to get to a suspension level vote, which is basically getting to 300 votes for the entire House. So you have to do it on a bipartisan basis. So I think the incoming speaker is going to really have to manage the committees in a more direct manner. And he or she is going to have to bring bills to the floor that can garner either like really large support of the entire house, which is basically a bipartisan measure, or it's going to be really difficult to advance things.
So not likely then to have a huge impact, I guess, like whether it's Patrick McHenry or Maxine Waters in that specific example for something that particularly in this case was bipartisan, right? I mean, do you think?
I would say it could have an impact, but it will be more incumbent on the authorizing committee leadership, such as Patrick McHenry, who's the presumptive incoming chair of the Financial Services Committee. He is going to have to sell crypto policy as a caucus matter to the entire Republican conference. And so there are these meetings that take place.
Oh, you mean even to get it on the agenda?
To get it on the agenda.
Yeah.
And like he's really going to have to own that mantle. And you can do it from a couple perspectives. You can do it from an oversight perspective, or you can do it from, I know we can get this level of support from both parties, and this is a good way that we can demonstrate that we can work across the aisle and get something done for the American people.
Tyler Williams, Head of Public Policy at Galaxy Digital. Thank you for joining, my friend.
Thank you for having me.
That's it for this week. Everyone stay safe out there. If you're in the southeast, watch out for Hurricane Nicole, which is coming. I guess when it rains, it pours. Have a great weekend, everyone. Thanks for listening to Galaxy Brains, the weekly podcast from Galaxy Research. If you enjoy the show, please like, rate, review, and subscribe wherever you get your podcasts. To follow Galaxy Research, sign up for our weekly newsletter at gdr.email, read our content at galaxy.com/research, and follow us on Twitter at GLXY Research. See you next week.